At the peak of his career, Jordan Belfort was making almost $1 million per week. He also mentioned in an interview that he made $49 million in cash and that his net worth was much more than that. Nowadays, making $1 million doesn't sound like a big deal, but in the 1990s, making $1 million meant a lot. Jordan Belfort was worth $200 million at his peak. How did Jordan make his money? We will see details of all the methods Jordan used in the movie Wolf of Wall Street. It is said that Jordan was successful because he had a very charming personality and was very persuasive while implementing these sales methods. This might be true up to a certain extent for his success. But the primary reason for his success was the lack of financial information available to the public. In the 1990s, access to real-time financial information was not as readily available as it is today. The internet was still in its early stages, and online trading platforms did not exist at all. So, in order to make an investment in the market, you actually needed to pick up the phone and call the broker. These registered brokers had real-time information, and they would suggest stocks to their clients to invest in. Nowadays, every single piece of information is available on your phone with just a few clicks. None of Jordan's methods would have worked in today's time. The journey of Jordan building incredible wealth starts after the Black Monday market crash. Jordan joined the Investor Center, where he found the brokers were dealing with penny stocks. The thing that made him interested in working at the Investor Center was that the commission was 50%. The penny stock market was different from the New York Stock Exchange. On the New York Stock Exchange, if a company wanted to list itself, it had to have transparency with its business and balance sheets. Basically, the company had to follow the rules. If the company did not follow the rules, it would be delisted from the exchange. In the penny stock market, or over-the-counter market, the rules were not that strict. And if any company that was not really good with their finances would approach these OTC exchanges and ask them to raise a capital of $1 million, then the exchange would say, "We will raise the money for you, but we will keep 50% of it." That's how these penny stock exchanges made 50% in commissions. Using his Wall Street skills, Jordan became successful in selling the penny stocks in the Investor Center. And from there, he got the idea that he could bridge the gap and sell these penny stocks to rich people with real money. Keep in mind that by rich people, he meant the people who only used to trade on the New York Stock Exchange. Initially, he opened a franchise of Stratton Securities, which was a minor broker-dealer firm. Later, he founded Stratton Oakmont, which bought the entire Stratton Securities firm. Now, in order to get the rich people interested in penny stocks, Jordan created a system of training his salesmen known as straight line. In this method, they would initially sell safe, good, well-known stocks to wealthy people to gain their trust. Once they gained the trust of these rich people, then they would sell them penny stocks, where they would make more money in commissions. The primary method he used was pump and dump. In fact, all of Jordan Belfort's methods were variations of the pump and dump scheme. To pump the stock price, Jordan would tell his friends, or in the movies, they were termed rats, to buy a large number of stocks of a particular penny stock company, often at a very low price. Then his team of brokers would aggressively promote these stocks to potential investors, using various tactics such as cold calling, high-pressure sales techniques, and misleading information. They would create an artificial demand for these penny stocks by spreading positive rumors and issuing fraudulent research reports. These activities would drive up stock prices, making it appear as if there was significant investor interest. As the investors had very few resources to get such information, they would usually fall for these tactics. Once the stock prices were pumped up and reached a certain level, Belfort and his associates would sell off their shares, making significant profits. This act of selling off the shares at inflated prices is known as dumping. They would often do this before the stock prices inevitably collapsed. leaving other investors with worthless or significantly devalued stocks. Let's understand this with an example. Let's say there is a company, XYZ, whose stock is trading at 10 cents per share. The market capitalization of all the stocks put together is $2 million. Then Jordan would tell his rats, or accomplices, to buy the $1 million worth of shares in this company, basically buying half of the company. This would create demand for that stock in the market. Then, Jordan and his team of brokers would call the investors aggressively and promote this company, creating urgency and recommend them to buy the stocks of this company. This would drive the stock price up. Let's say it went from 10 cents to $1. At this point, his rats would start selling the stock at its peak, making most of the profit. If Jordan's friends bought $1 million worth of stocks at 10 cents a share, they would get 10 million stocks. And they sold when the stock price rose to $1, then it would make them $10 million. That's how they made their money, by duping their own investors. Another scene where Jordan takes the company for an IPO, Jordan identifies shoe designer Steve Madden Limited as a potential candidate for an IPO. He recognizes the brand's popularity and growth potential, seeing an opportunity to profit from the offering. Belfort and his team at Stratton Oakmont worked to generate investor interest in the Steve Madden IPO.
And I want you to ram Steve Madden stock down your clients' throats till they fucking choke on it. Yeah. Till they choke on it and they buy 100,000 shares. That's what I want you to do. You be ferocious. You be relentless. You be telephone fucking terrorist.
To drive up demand and increase the IPO price, Belfort and his team would engage in price manipulation. They would intentionally create an artificial scarcity of stocks by purchasing a large number of IPO stocks themselves. This manipulation would raise the price and create the perception of high demand, attracting more investors. Once the Steve Madden IPO was launched, Belfort and his associates sold off their shares at the inflated price, making substantial profit. That's how his firm made $22 million in 3 hours on the IPO trading day.
$22 million in 3 fucking hours!
The $22 million Jordan made was because Jordan owned 85% of the company at the time. On IPO day, he sold off his stakes. Today, Steve Madden's company's valuation is around $2.5 billion. If Jordan hadn't sold his stakes, he would have been worth $2 billion now. Stratton Oakmont launched the IPOs of 35 companies, and they used a similar strategy in all of those IPOs. The officer who investigated Jordan has broken down this strategy. The first step of the strategy was to create an IPO stock. Stratton Oakmont was always looking for companies they could take to the public. One of the important steps of the Stratton IPO was that it was not really sold to the public. As Stratton was launching these IPOs, they were the underwriters of these IPOs. The securities law allowed the underwriters to buy only a small percentage of the IPO stock they issued. So, to bypass this, Stratton initially sold the IPO units to only their friends. This selling IPO to only friends is also mentioned in the movie, but most people probably missed this part.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking the company public, we set the initial sales price, then sold those shares right back to our friends.
Stratton used to sell all of its IPO stocks to friends like Steve Madden. These friends were also nicknamed flippers because they would sell the stocks right back to Stratton at a slightly higher price. For example, if Stratton sold the IPO stock to their friends at $4, then those flippers would sell back the stock to Stratton immediately for $4.25. This was a good deal for those flippers, as they could earn a quick profit from an IPO without any risk. The second step was to line up the victims. During this stage, The salesmen at Stratton would gain the confidence of their investors. The way they did this was by letting these investors make some profit in 1 or 2 Stratton IPOs. Once trust has been established, the salesman will inform them about the new IPOs. As the customer had trusted them because of their previous trades, they would invest in these IPOs. The third step was to bait and switch. Just before the IPO, the salesman would call the investor and tell them that the IPO was in very high demand and they could only buy very few stocks at the IPO price. Let's assume that the IPO price is $4. As the client did not get the stock at the IPO price of $4, the salesman would then say that they would buy the stock immediately when it went on the exchanges in the open market. Many of their clients would hesitate to give permission to these salesmen, as they wouldn't be sure of the price as the stock gets listed on the exchange for trading. At this point, the salesman would use high-pressure tactics to convince them to invest in the stock anyway. By the way, guys, if you are enjoying this video, then don't forget to like and subscribe to the channel. The fourth step was market manipulation. This part was actually clever. Let's say there were 1 million IPO stocks issued by Stratton. The price of the stock during the IPO was $4, but Jordan wanted its price to go to $12, as all the million stocks were held by Stratton itself. So, after listing on the exchange, they would create sell orders for very small quantities of stocks at slightly higher prices. Let's say the sell price is $5. At this price, his friends would buy the stocks, and then Stratton would set the next sell order for $6 and then for $7. They would keep doing this until the price reached $12. By the time the price reached $12, a very small quantity of stocks would have been sold to their friends. This price rise from $4 to $12 would happen in just a few minutes. This was also mentioned in the movie. Jordan could have directly set the price at $12, but that would have raised suspicion with authorities. By going this route, the market also recorded the price of the stock going up steadily from $4 to $5 to $12. In the 1990s, this was usually the first day's trading pattern, so nobody suspected any foul play in this manipulative price rise. The fifth and final step was to sell high and shut the door. Once the price reached $12, Stratton would execute the orders of all its customers. Now, initially, the customers were promised to get the stock for $4, but they got it at an inflated price of $12. If any of the customers wanted to sell, then the Stratton brokers would just tell them that their sell order was lost, or they would just stop picking up their phones. All 35 IPOs were launched this way. During the investigation, the friend or flippers were also found guilty and they also served jail time. This is how the pump and dump schemes of Jordan Belfort actually worked. If markets are not heavily regulated, then using pump and dump becomes very easy. Nowadays, such schemes are used in the unregulated cryptocurrency market through Telegram groups and Discord servers. If you are in such a group, stay away from it and do your own due diligence before investing money in such crypto coins.